Here, holy cow.
Yes, sir, I will fire away.
All right, good. Well, I guess the first agenda item, if I can recall, is the approval of the minutes, correct, from the last meeting?
From November 9th, yes, we didn't have a quorum.
Yes. Yep, November 9th. Do I have a motion or any questions on the minutes from the last November 9th meeting? Motion to approve?
Rich.
I hesitate, Chris, because I wasn't at that meeting.
I think only you, Chris, and John were there, correct? Or you weren't there?
I was just trying to think about.
I don't think
it was
you
so
were
long
there.
ago. I don't think I was there.
Mike was there with them in the November meeting.
Yeah, you were
Yeah.
there.
John, Chris, Rich, Mike, Evan.
You were there.
I'll motion to approve.
All right,
You're so formal here.
Second the motion.
Okay, perfect.
excellent. Excellent. We can move on then to the next piece of business, which is our first quarter investment review. And we'll let Perry kick that off, correct?
Yep.
Okay, great. Open up page 1.1. So the good news is 2 quarters in a row, positive numbers. Fourth quarter was a positive quarter. And, obviously after the first 3 quarters of 2022, it was nice to get a positive quarter in. Overall, for the fourth quarter, you got your presentations. We did well that quarter. So that was a good sign too, as far as, taking advantage of the markets coming back. You can see here on 1.1, the Russell 3000 came in at 7.18%. That's what we utilize in your benchmark. Pretty much across the board, positive numbers in domestic equity. The only area that was negative was Russell 2000 value area. And the other key thing to point out is small cap and mid cap did underperform compared to the Russell 3000, compared to the large domestic equity side of things. So you can see, they outperformed their benchmark. They were decent numbers as far as positive. You can see the mid cap came in at 4.06 and the Russell 2000 index came in at 2.74. But obviously the S&P 500 at 7.5. The large cap actually outperformed small and mid. Not an expectation of ours. We went in starting in the fourth quarter of last year. We felt that we would start to see small and mid cap outperform large cap, but in the first quarter it actually did that for the first 2 months, and then the banks started collapsing and mid cap and small cap, their performance pulled back. So with that international, from that standpoint, solid numbers there. We utilized the third benchmark down. That's the Morgan Stanley All World ex-US, came in at 6.87%. And the fixed income area, the ag, that's 2 quarters in a row of positive numbers there too, which was long overdue. And actually a decent number of 2.96% for the quarter. So we're starting to see fixed income in the ag starting to return. With that, opening up to page 1.2, just a few things to go over. The IMF, the International Monetary Fund, actually revised their global growth outlook downwards about 10 basis points, not tremendous downward spin, but they retracted 2023 down to about a 2.8 projection and 2024 to a 3% projection. Like I said, overall down about 10 basis points for each year. So obviously we've had a lot going on from a political standpoint internationally, and I think what you're starting to see is the monetary policy and how much it's tightening in both from here domestically with our Fed and then with the ECB, tightening up too. It's getting dicey out there from a growth standpoint. Everyone's trying to slow down inflation. The inflationary pressures have slowed, without a doubt. If you look over, where was that page? Down right here on 1.2 in the bottom left corner, you can see that we went from a peak of 9% last May to last March-May timeframe to about 5% now from an inflationary standpoint. The Fed is still focused on getting back down to 2%, which is where it was at for almost 20 some years straight. So from that standpoint, I believe it's starting to look like it's a lofty goal. They're starting to see where it's starting to hang up here a little bit around 5%, and I think they're going to struggle to bring that down to 2. They're really going to hit the crossroads of that's always perfect timing. So they're they're hitting that crossroads of, how much more can they raise the Fed rate, slow the economy down, and not, take us into a deep type of recession. Right now, everything's been focused on that it'll be a soft landing and a shorter time frame from a recessionary standpoint. It always becomes a trick of measuring that, and when do we say we're in that recession? And it's always going to be data after the fact when we're willing to say that. And right now, it's still mixed messages. If you look at page 1.3, the chart in the top right corner measuring the manufacturing and service production, both of those numbers have come down considerably. You can see that the blue, which is manufacturing, is well below 50 now. And when it's below 50, that's more recessionary retraction type of indications. When it's above, it's indicating growth. And you see service, the yellow line actually dipped below and then it came back up, and now it's riding just above 50. So it may be above that as far as whether it's, a measurement of retraction at this point or not. But really, when you look at service and where it's off of its peak at, almost 67, it's considerably down, obviously, to be down around 51. So we're seeing slowing there. But what we haven't seen is from an unemployment standpoint, the unemployment rate is still at 3.5%, which is historically, a very strong number from an unemployment standpoint. As I've said before, the Fed tends to look at 5% unemployment rate as being fully employed. That last 5% is usually not matching up from a skill end to what's out there, and that's it, or they're really not looking for the work. So the unemployment rate is still indicating, very strong standpoint. And then actually labor force participation actually increased to a pandemic, post-pandemic high of 62.6%. It's about a percentage point off of where it was at prior to the pandemic at 63.3%. So once again, another good sign from a labor force standpoint. Fourth quarter produced 853,000 jobs. First quarter, the total non-farm payroll increased by just over 1 million. Overall, by the months in the quarter, March did slow down, only about 236,000 jobs. So, they're starting to feel like it's slowing down, but right now the numbers are still posting really strong. So, like I said, it's a bit of a mix out there from the standpoint of we see overall production down, but we're still seeing a very strong employment number. And so that becomes the struggle of where are we at, and then with the Fed, how much more they're going to tighten. The last meeting they just had where they raised another quarter point. They did seem to, kind of dance around the idea of not coming out and saying pausing, but all indication seems like they're going to pause a little bit. It would make sense to kind of step back and take a look for a little bit here and see how it runs. Just because, like I said, what we're looking at is if they continue to go up, then maybe we're not talking about a soft landing, short recession. They could be pushing us into something much deeper, So they have to walk that fine line without a doubt. Overall, page 1.4 and 1.5, P ratios, both domestically and international, are still favorable compared to their 5-year averages. Both of those charts are in the bottom right corners of those pages. So overall, from an equity standpoint, still see potential for, increasing the ability to get more from it. Yield curve, is inverted. That's another indication of typical, going into a recession time frame, and it's just a matter of watching some of that play out. Real estate has been an interesting area. We believe, and we actually pulled out of this in the fourth quarter, was we had a REIT in your portfolio, just basically holding real estate across the board. We pulled out of that because we believe that the only area you're going to see positive types of things going on in real estate is private real estate. A lot of the commercial is going to get banged up with where interest rates are today. They're still reeling out of, how will commercial buildings really look with COVID, and who's working in the office and who's not. Because I'm sure you've heard this and seen this. What a lot of employers are dealing with now is people are like, hey, I don't really want to come back to the office. So it's changing the structure of a lot of companies, how they're operating.
Have you seen any reports where companies are downsizing, are moving into smaller buildings?
That's what like we're looking at numbers, and that's what they're trying to see is like what's really happening. A lot of this goes with if you were in your lease, you're in your lease and you can't really move around,
Yeah.
right? So it's like now, let's say some leases starting trying to see what companies are doing next. Because there was also a view that space would still be occupied simply because employers were going to start spreading people out. So maybe they have the same floor space and they just have, you know, much more space between people as far as like, no more of that like cube on top of cube type of concept. So, you know, there's mixed messages there of how it's really gonna play out, but I believe what we're gonna start seeing over the next couple of years is how is it playing out? You know, the next time a company comes up with a lease, what do they do next?
Yeah.
You know, how do they break it down and what do they end up with? Because I know when I go to our offices in Philadelphia and Harrisburg, we're on that mode where people are in like half the time. So, you know, anytime you're in the office, you only see half the people anyway, you know, it's almost like they're rotating days. So it's still kind of I feel like I'm walking into a ghost town office, you know, that's kind of.
I walked into my old office and they have smaller space. But I think they're kind of consolidating within that one building, but I'm just curious, you know, when that lease expires, whether they'll try to think of moving into, you know, smaller spaces and trying to accommodate they call it the new reality, but it turns out to be a new reality that, maybe people go to just cubicles for everyone, you know, you could call it a reservist space
Right.
rather than having your own space and.
I have a feeling when it's all said and done, it'll probably be a little more toward that idea of everybody more spread out. Because I believe what they're gonna start seeing from a company standpoint going down the road is, you know, it's fine to, I don't know, work from home when you have 10 years of experience, but when you keep, you know, the new people you bring in, how do you create a culture if there's no one's there, you know? And so I believe, you know, somehow companies are gonna try to find a way back to that without a doubt. Like I've read a lot of articles where companies are crossing that road where they're saying, no, you have to come back.
Yeah.
Like it's now time to come back, you know? And so.
If job market has, if there are vacancies and that becomes more difficult, people say, well, I'll work someplace else.
Right.
And so,
And that's what's next. So like back to that unemployment rate, if the unemployment, like if that actually starts to tighten and the rate starts to go up and now all of a sudden jobs aren't so. I'll just go somewhere else kind of concept, then, you know, all of that starts to structurally change. Unless you're 23 or 24 and for some reason you just quit because you just still live with mom and dad, you know, so those kind of things change.
Since we're specifically on private real estate, how is LEM and Equus handling this
Yeah.
piece of?
LEM, this has been a little more of a struggle for them because they were more multifamily home type of concept, so they've struggled. Equus has done fine, like they're holding their ground because they focus more commercially, but not only do they focus commercially, they focus on buildings that have more specs on them, well, more governmental type of buildings, police stations, fed buildings, things that the tenant doesn't tend to leave because they've had specific specifications to what they need in their building, so then they're staying. So Equus has fared this market much better. LEM has definitely had what I would call the experience of the fluctuation. You know, they have their 1 year number is a negative number, for example. And so they're gonna probably have to go through a much more bumpier stage over the next year or two, I would imagine, you know. But like I said, Equus was kind of set up in a little bit better position. So with that, a couple things here on page 1.9, just from a viewpoint. As I said, fourth quarter, one of the first quarter here, we had a view that small cap and mid cap was going to outperform large cap. That did not play out well for us in the first quarter. And from every indication, investment committees, everything's coming out of our investment committee. We're probably going to pull back on the overweight we had in small cap and mid cap. Matter of fact, the decisions being made this week. So you're going to see this chart change somewhat for the next quarter. We'll probably be neutral across the board from a domestic equity standpoint with small cap and mid cap. Internationally, you can see pretty much we're neutral across the board. We see potential everywhere from a standpoint for the international markets to take off, but obviously the war in the Ukraine is a big issue. China is kind of turned back on now. They've kind of gotten away from how often they were shutting down. So starting to look to China to probably, to start to produce more, which will have a positive effect on emerging markets in general. But once again, there's still a lot of just international tension. It's not a good situation from that standpoint. But so with that, somewhat neutral across the board. And then fixed income, for the first time in a long time, we've increased our outlook on long duration and interest rate sensitivity, going from really being a slightly negative approach to being more neutral there. Still, right now, still feel like the credit sensitive areas are where you could really add value. But you're starting to see it now, with the Fed rate being where it's at. If they start to hold up and the next few months struggle through, we're gonna see pretty consistent returns in the fixed income area. So really over the last 6 months, we've been increasing. We were significantly underweighted in fixed income for years, like about 5% underweight, probably for the last 5 to 7 years. And we're now pulling it up toward target pretty much from that standpoint, because we believe we're gonna start seeing pretty solid fixed income numbers. The overall concern is, as we go into 2024, and this is why I think all the experts are kind of really leaning and pointing toward the Fed taking a break and, pausing on the Fed rate, is if we go into a recession that is longer than expected, 2024, they'll probably start to play with the rate the other way. And it'll kind of cause more havoc kind of coming back down, so that's where we're hoping that they kind of take a step back and say, let's see what the numbers will bear out for a little bit before we keep increasing. I think every expert out there is pushing it that way, so we'll see how much the Fed, takes in from there. So with that, opening up to second section, executive summary, 4 plans in front of you. For the quarter, police plan came in at 4.71 versus the benchmark at 4.99, so slight underperformance. That came in, a couple managers in the domestic equity area underperformed a bit, and actually the overweight to small cap and mid cap had an effect on the performance in general. Like I said, it was positive numbers, but large cap outperformed, 300-400 basis points compared to the small cap and mid cap area. So having the overweight kind of detracted on performance from that standpoint. So all 4 plans relatively come in the same area. The employee plan came in at 4.65, and the firefighters at 4.61, and the OPEB trust came in at 5.26 versus the policy at 5.63. So overall,
Just for a second, can you, for Ron's edification, why OPEB would be 50 basis points, 60 basis points different? Can you explain that as a new number?
yeah, so on an equity fixed income basis, the overall allocations are the same across the board for all 4 plans, but the difference is that the top 3 plans have an allocation to alternatives.
Okay.
So and the smaller plan does not. So basically, for that quarter, just outperformed for overall from a.
And they report quarter late,
Yes.
so they're a quarter behind.
That's the other issue. There's several things.
Pension plans are a quarter behind.
But all the alternatives essentially are a quarter behind.
Yep.
So if you go deep into a page, you'll see a lot of 0.0 returns for the quarter. The numbers aren't in yet. So that adjusts things a bit too, from the standpoint of where that comes out. And obviously, not only the benchmark, but performance, everything's in 0 for those managers. So with that, those are 4 plans. I'll dig into the police a little bit deeper. That's the next section. So page 3.1, this is the full layout of all the allocation and the managers in it. Back to what I was discussing, Nuance all cap underperformed compared to the benchmark. And that makes up about 7.5% of the domestic equity allocation. And also Aristotle had some underperformance, about 200 basis points for Aristotle, about almost 400 for Nuance. So, being that makes up about 14% of the equity portfolio, domestic equity portfolio, there's some performance there. And as I pointed out, the bottom 2 managers are your mid cap and small cap. It's not that they didn't do well versus their benchmark. It's just large cap equity came in over 7%. So the overweight to the small and mid cap affected the overall performance. Dropping into international, 2 of the managers did underperform, significantly for the quarter. That was Arcadian and Aristotle on a quarterly basis. But with that, overall international, it did well compared relative to its benchmark. It was hanging right in there with it. Fixed income managers did, fairly well across the board. Overall performance for a fixed income fund was 3.10 versus the ag at 2.96. You had outperformance in the fixed income area. Increasing the allocation to target helped also in the portfolio from that standpoint. And then At the bottom of 3.2 and going into 3.3, these are the alternatives, and this is back to what Andrew pointed out. All of them have zeros in the quarterly performance. So as that comes in, that kind of tightens up the performance better, which takes, another quarter before those numbers come in. It's always a quarter behind. But as I was talking about Equus, we were talking about Equus and LEM. So you can see on the 1 year basis, Equus actually came in at 0.76 to positive on a 1 year basis versus its benchmark at negative 1.63. But LEM was a negative 10.5 versus the negative 1.63 benchmark.
Sorry, question on the international, are those hedged back to the US dollar?
The funds,
Yeah.
Yeah, they're funds, so you don't own anything directly international.
Right, right.
So
Okay, but they're not hedging back to the US dollar, so any dollar movement downward, which we've seen is a.
it's an effect.
Right.
Yeah, well, yeah, it's a positive effect for the international
Sure.
side. Yes, yeah.
So the international reflects the currency values, I mean, that,
Yeah, the managers are in there.
okay.
Yeah, that's all pulled together.
All right.
So with that, the key thing too, I want to make sure you point out is, obviously the quarter, a little bit rough performance. 2022 wasn't the greatest year, with some underperformance throughout the year. But overall, the plan and where you're at on a long-term basis is still sitting very much where you want to see it. Your 3-year number for your plan is at 9.93 versus the benchmark at 9.74. Your 5-year numbers at 5.99 versus the benchmark at 5.71. 7-year numbers at 7.25 versus 7. And then from when we
What
switched,
page are you on?
I am on page 3.1. I'm sorry.
You're still back on 3.1. Okay, you moved back up.
Yeah, I apologize.
It's all right.
I'm a page flipper. But yeah, so I'm just going across that top blue bar across the top is the numbers I was reading to you. So the November 2015 to March 2023 column is when we switched from traditional consulting to the OCIO approach, where we share more of the fiduciary responsibility and have discretion over making moves within the portfolio. So that time frame, 6.74 versus the benchmark at 6.54. And then overall inception going back to 2003 when we started working with you, 7.02 versus the benchmark at 6.62. So very much the long term is where we want to see it. The short term has not been great on a relative basis, but from a standpoint of the last 2 quarters being positive, starting eating into that big negative number that we were experiencing in 2022. So that's a good turnaround. I'm going to flip now, Andrew, a few pages in to 3.7.
Your favorite page.
Yeah. But this, I call this my hard dollar report. It gives you the dollars. Say, this is where the money is. So, what did your percentage return mean to you for the quarter? It meant your return on investment was $3,149,000. Net flows for the quarter were a positive $58,860 or $868. So overall, you started the calendar year at $65,466,000, finishing up at the end of March 31st at $68,674,000. Yeah, going from 65 million to 68,000 would be a little concerning. So good positive growth that way. We can see on the 1 year basis, the negative numbers we have, geez, at the end of September 30th, it was a double-digit negative. So that was a very harsh time frame. So you can see now that return on investment for the last 12 months it's got a better negative number, I guess the way to put it. It's down to 4.7 million, where 6 months ago it was double that. So that's a good positive from that standpoint.
Net flows, that benefit payments, expenses.
Yes.
Contribution, if any.
Exactly. And that's why you're positive there, Andrew, made a contribution in the first quarter. You guys do one thing that's really smart compared to, I actually finally have another client doing it because I told him what you were doing. So,
Do we get anything for that?
he helped someone out.
More references, more reference calls.
Yeah, exactly. But no, the city of McKeesport started doing it. I was really happy because they're obviously in a complete different struggle than you guys are from a standpoint. But basically, public plans do their contributions. Typically, the state sends out money at the end, like October. So a lot of public plans just wait to do their contribution for the year until then. Andrew basically drops in money every quarter, so it's a little bit more of a dollar cost averaging approach. And it just makes a difference overall throughout the year. So I have the city of McKeesport doing it now too, and it's helping them for the same reasons, because if you wait, good chance you gave up, 9 months of performance. And the problem is your actuary, when they do it, they look as if the money is there January 1. So the way they're crunching the numbers not helping you, doesn't help the situation.
Yeah.
So at least if you're dropping the money in throughout the year,
Every day you wait, you have an actuarial loss.
yeah, basically. So by doing it, you're lessening that loss, it's a number crunching, but it makes a difference over the long haul.
We started that 5 years ago doing that, so.
Made a difference. Like I said, so anyway, I'm working on it. I keep, working on my class the same way, because I'm out of the 16 municipal plans I have, 2 are doing it. That's it, We have over 90 plans in the state, and I imagine the numbers are about the same. So with the last page I'd like to cover is page 3.8. This is your the light blue bar in the bottom chart. The light blue bar represents your target allocation, and the dark blue is where you're allocated at. So you see we have you slightly overweighted domestic equity at 41.4 versus the benchmark at 30, or the target at 39. And same with international, well, not quite as much, but you're just slightly about 0.7 overweighted, 21.7 versus the target of 21. And as you can see from a fixed income standpoint, we have you much closer to target than we've had, like you're at 26 versus 28. A year ago, that was at 23 versus 28. So we're increasing your fixed income allocation. And then you can see your private equity target, which, we just really entered private equity at the end of last year, September. We added a private equity manager. And then your private debt's pretty much on target, real estate's on target, and cash, we always keep it around 2%.
Perry, are there bands around those target allocations where you have to rebalance back to target?
No, I wouldn't call it, well, we can go 20 on either side.
20, okay.
So it's not we don't have we much more manage the allocation by what we see coming in the markets
Sure.
and the economy, as opposed to having like a set view or 3 over and go back to.
Got it. Okay.
And that was a large discussion around that when we changed the IPS
Okay.
for that specific reason. There was a lot of discussion around that.
Well, because if it's too tight and there's a ton of volatility, you're always. going
Yeah,
back and
it's
forth.
20 too much and so on and so forth, but we settled on there and it's worked. So, but there was, when we did institute the new IPS, we did discuss that.
And I would tell you historically, although there's a large band, we tend to be within 5% of the target policy on either side of it. So like when we do an overweight, if we're 3-4% overweighted, that's kind of a large overweight for us. And I would say more than a 5% underweight is a large, would be unusual and a large underweight.
And are there bands within the asset classes within? So for instance, if you're targeting X in US growth or US value, are there bands built into sub asset classes then as well?
We're much more, we do a core approach.
Okay.
So we're always looking for core managers, typically, because we look at it as if you're trying to pick value and growth, you're just increasing the chances of making mistakes for your client, basically. If you pick wrong, you've increased your risk, of picking it right. So we go more core driven, and the policy doesn't dig that deep into it. That's a little more of an internal for us on where we would run on a relative basis. So like we look at the Russell 3000, for example, and we model that. And then if we overweight or underweight within that, it's just off of that.
Okay, so you have the latitude internally.
Yes. And the other thing that we do run is we're definitely a passive and an active manager together. So you'll see, if you're looking closely at some of the choices in there, you'll see indexing and active mixed in there together.
Okay.
We tend to be active predominantly in fixed income, in domestic equity, more passive than active, and international is kind of about a 50-50 split. Where we've been over the last 7-8 years. That's it. I mean, we can go each plan is modeled the same way. So going from each one, I think is, just dragging you guys through pain.
We focus on the police plan just because it's the first model.
This is the first model was way bigger, So with that, as I told you from a standpoint of where the underperformance came, it came from from a few managers and basically that overweight to small cap and mid cap. And as I said, I believe we're changing that overweight rate right now as we speak. Any questions?
Hey, Perry, Chris here. Can we go up to page, I think it was 112, where we get into the attribution analysis?
Sure. That's the last section.
Yeah. I forget what the, I've got to get to it myself here and get to, let's see. Dun, dun, dun.
8.1,
Correct. Well,
right?
Yeah.
yeah, if I look at
But what are you looking at the
page,
page 4?
page 8.4, yeah, 8.4. So when we look at this and we're looking at the, where the outperformance, underperformance comes from on a quarterly basis. I'll wait till you guys get there. There you are. You can see the green graphic here that shows where we were hurt the most was in fixed income and private equity from a quarter perspective. And if we go to the next page, it just shows you the 1 year, maybe the 1 year is a better one, but can you explain the underperformance in fixed income? I think I know what it is, and I just want to hear, see if you agree with what I think it is. Where we're negative 3.69 in fixed income and negative 291 in private equity.
Right. I came back, I believe it was the same issues as far as allocation and a couple managers underperforming.
Yeah, it's probably duration is probably what I'm thinking, is because the fixed income market over the last year, if you had any overweight to, duration, you got hurt. You were best off being very, very short duration. So it was probably just that allocation decision in the managers, that you had managers that, were managing more down the middle with, say, an average duration of 4 or 5 years or so.
Yes, the core managers stayed with their duration targets right in that range. So you're right, there was definitely, there was definitely the underperformance there.
Any idea why the private equity, what the variance there was?
I think because we just added it, so the numbers aren't like pure and clean yet, because that was just added in September of last year.
Okay.
So, the 1 year number is definitely not going to show like accuracy.
All right. Okay.
Yeah.
Thank you.
That's Chris's favorite page.
Oh, is it?
This
It
Chris's
is.
Good page, good page.
People have their
I had him
favorite
put
pages.
that in there.
And Perry, you may have said that, so the duration on the fixed income, is it ag-like? I mean, is it the
Yes,
six, it's in the 6 range?
Yes, we look to manage to the ag, to beat the ag. That's kind of how we measure it up. So we will use some managers that are not, ag related, or that wouldn't be their direct benchmark. But our viewpoint is, what we're selecting in our fixed income is all designed to ultimately beat the ag.
Got it.
So for instance, we may have a high yield manager in there, something like that, but the whole point is to utilizing the allocation to beat the ag again. But yeah, so over time, duration has been, over the last 5 years or so, duration has been our least favorite area to be in from a fixed income standpoint. Like I said, the dots we had in that chart where we were under slightly negative, it's been there really since I've been here. I joined the firm in 2015. We've been slightly negative on duration fixed income for that long.
Any other questions? All right. Chris will move on.
All right, excellent. Thank you, Perry. Do we have any new business items to discuss today?
Yes, I do. It's that time of year. We got our actuarial valuation reports back for the 3 pension plans that you see before you today. We have very positive news. We only made one slight minor change to the smoothing aspect. So in our actuarial plans, if I haven't explained it before, it's not done on a market value of assets to determine your liability percentage. It's done on a smoothing, so it looks at 4 years of returns and smooths it out over time. We compress the goalposts a little bit to make it a little bit smoother moving forward. One, because we can afford it to do it and make sure that we put the right amount of money in the plan at the given time. So even with that change, which does increase your liability to a point, we still came back with our smooth. We called the actuarial valuation of assets at 96.1% funded in the police plans, 108% in the fire plan, and 105% in the general employees plan. So if you look at it, would be lower if you looked at it at the market value of the assets, not the smooth value. But that's not what we use for Act 205 purposes. Act 205 being the pension legislation that we use in order to determine things that like our pension funding that we have to put in every year, called our minimum municipal obligation. So this is all positive news. This will determine our contribution for 2024 and 2025. They only use the odd year valuations. 1/1/23 valuation determines funding amounts for 2024 and 2025. In a memo I delivered to the commission, to the manager, then onto the commission, we should have stable MMOs for the next 2 years based comparatively to 2023. In addition, we'll have a large amortization payment falling off in the police plan to the tune of over $400,000. So that'll be a boon to the general fund at that time in 2025.
The MMO, what does that stand for?
Minimum municipal obligation.
Okay,
So that's every year we turn in wages to our actuary and say, here, based on our normal cost, our administrative expenses, amortization payments, or funding adjustments. So those, and I'll get into those in just a second, but based on all those, with those wages, with your normal cost, it then determines how much the municipality has to put in every year. And so based on our 1/1/23 valuation and everything I just explained, what it's telling us is that in 24 and 25, it should be steady with a large amortization payment falling off. So there's not going to be a huge, in some years, there's been years where I've presented to you as a board that says, hey, by the way, we have a $300,000 increase in amortization payments. Right now, we have a steady plus in 25 having a large amortization fall off for us.
That's including all of 2022.
Mhm.
That's beautiful.
That's correct.
That's really.
Yeah, that's great.
So the asset smooth you said used to be 4 and you compressed the goalpost.
Correct. It used to be 20% on each side. Now it's 10% on each side.
Got it. Okay. So it's still smoothed over 4 years.
So smooth over 4 years, or just our goalposts are now moved to 10% so that we can't. So that we take more of the gain and more of the, and move it together to. So that's there.
the police is still underfunded, did I hear you correctly?
That's correct.
Okay,
That's
so,
correct. In the state of Pennsylvania, anything above 80% is considered fully funded.
okay,
As in not in any trouble in any way, so on and so forth, for Act 205 purposes.
okay.
Anytime you start dipping below 80% in your valuation process is really when things start to get concerning. So we're very well funded as a police plan for
Okay.
sure. And to your point, they're about overfunding. So we're at 108%, as I said, in the fire plan, 105% in the general employees plan. When that happens, Act 205 mandates that you actually pull back and get back to 100%. So they never let you stay over 100%. They don't want you to stay over 100%. They want you to be at 100%. So similar to the amortization payment I'm talking about with the police plan being underfunded, under 100% funded, we actually get a funding adjustment in the police or the general employees and fire plans every year because we are overfunded. So it decreases our payment over time. So we've been overfunded in those plans for at least since 2019. So we're hovering right around where I think we need to be. We're not at 120%, but we're between 100 and 110%. That's where you should hover. That's where your goal should be.
How do they amortize that? The UAL? You're talking about the amortization payments.
Yes.
How do they structure those?
So there's a whole schedule within they depending on what it is, whether it's the actuarial loss, whether it's an experience gain, if it's an assumption change,
Right.
whatever it may be, they have different time frames in which they amortize it, which over 10 to 12 years, they'll amortize that gain loss assumption change, depending. Yeah. And when you're overfunded, they're not there at all. Right? So even if we had experience that nothing's amortized if you're overfunded, it's only amortized if you're underfunded. So all plans are good. That's kind of the report. The good news for our pension funding and work. So the good work of the board and having this type of board has helped over the years. So that's
Oh. Thanks. I'd like to say we work really hard, but I think you do all the lifting.
well, I think it's been 20 years since they made this change.
Yeah.
So long before I was here, 10 years before I was here, they were making this change. To where first starting with the consultant model, and really paying attention to it, creating this board to look at it, it's paid off. That's just all there is to it. There's people that have all come before us that this is now evidence to why we did it.
Excellent, excellent.
That's all I got.
All right. Anything else then?
That's it.
It's fun when you have these easy meetings like this. All right,
All
so,
right, we'll adjourn at 9:40.
okay,
right.
do we need a motion for adjournment or are we good?
I think we're all packing up. I think we're good. All right, Chris,
All
enjoy
right,
South
guys.
Carolina. We'll see you.
Thanks, you guys be good,
Bye.
thanks.